onward to additional inputs. I combine that with cash flow because neither one of these require a lot of input, but they require some thought and definitely some action. I'm going to start on the additional inputs and ask you all to make these changes. And I've kind of left this in here and talk because I want to talk about it. It's kind of a teaching moment. I could change this on the template, but and then I wouldn't be able to talk about it a little bit. Income tax assumptions. I want everybody to change all of these to 0. Okay. This gets back to whether you're a C corporation or not. C corporations pay taxes. Other entities can choose to pay taxes, but that's extremely rare. If you think that you want to be a C corporation or a tax-paying entity, let me know. Otherwise, these are called pass-through entities, and almost all sole proprietorships, LLCs, LPs, all those types of entities are pass-through entities, meaning that the tax liability passes through tax liability or benefit passes through to the owner or owners. Okay. So again, unless you think that you're a taxed entity, and I have had some exceptions there. For some, in our area, there's some benefits for ag corporations, ag C corporations. They get some write-offs that they might not otherwise get, and so there are some exceptions to that. But for the most part, the businesses that we do in this class would not be exceptions. So change those to 0, or let me know. And then I also want you to change this amortization period to 1. Okay. Oops. How do I let me make those other changes? I have to come up and do the unprotect the old sheet. Okay. I guess those cells maybe aren't protected there. So we change that to 1. That one's not so much teachable moment, just as a thought that for what this does is it takes those startup expenses and it might amortize those over an extended period of time. And let's not confuse that with the depreciable expenses. A building is going to be depreciated out over 20 years, and equipment's going to be depreciated out over 5 or 7 years, etc. Okay, this is just some of those other startup expenses like your insurance and some of those things, perhaps. And I just don't, for the life of me, with the small business, especially the type that we're looking at, see where we would actually amortize those out over a period greater than the first year. Yeah. There could be some businesses and there could be some circumstances where that would be the case. I don't know of any of your guys' businesses that would, and so that please just change that to 1. Okay. Then also on this sheet, a couple things that you may or may not have. The percent of collections. This one, it depends on your business. Okay, a lot of you are going to be a cash business, and what would that mean? So let's say you are the coffee shop. Yeah. Okay. You may collect 100% of yours. People are going to pay you. They're going to give you a credit card. They're going to give you a check. They're going to pay you cash. Okay, so you're going to receive 100% right up front. Okay. If that's the case, then the rest of these have to be changed to 0. Okay. So that you have 100% down here. Okay. On the other hand, you might do the carpet cleaning service, and there might be some people that will pay you right up front. Okay, and a lot of people that would pay you within 30 days. You send them out a bill and whatnot. That might be 50% of the people. But you might have some people that are a little bit slower in paying, okay, and that might be 40% of the people. And you might have 5% that are really slow, and you might actually have 5% then that don't pay you at all, so they become bad debts. Okay, and that's how you'd put that again. It has to add up to that 100%. This 5% for the bad debts, it's going to show up on our income statement, and it'll automatically calculate that for you. For a lot of businesses, that might the 50-40 isn't necessarily typical. You need to kind of think that through on your business and how you're going to get paid. Okay, this is one of those things that I will definitely pay attention to. and see how, because different businesses get paid in different fashions. There's just no question about that. So try to think that through, how you're going to get paid. It could change from one year to the next, but for the most part, this is going to be relatively consistent, right? If you're paid 75% within 30 days, that's probably going to stay consistent throughout years 2 and 3, but feel free to modify it a little bit if you want to. Okay. Then accounts payable. When are you going to pay? And again, this may well, this is going to be for your things like your inventory, especially, when would you typically pay for that? A lot of places give you maybe a little discount if you pay within 30 days. And so this has to add up to 100%. Again, too, you need to think about it. A lot of places are going to bill you and give you that 30 days to pay. And so you may pay, like they have here, 100% within that 30 to 60 days. That may be your contemplation. You may have multiple suppliers where some of them, you think are going to want to get paid right up front. That may be 20 or 25%, then the rest of it might be 70, 75%. Okay. And so again, that needs to equal 100%. You can certainly choose to have a minimum balance in your checking account. Some people don't like to fall below a certain level. Okay. And when we get to the cash flow, if you fell below that, it just means that you'd get a cash advance on a line of credit. Line of credit interest, 8%. Maybe in the ballpark. That's probably a little bit high, but you may check with a bank or whatever and see what they might charge for something like that. Okay, additional fixed asset purchases. This is going to be rare. There may be some of you that would consider having some additional purchases, right? Okay, this is not the things that you purchased up front. It is not, it's not a repeat of the things that you already put here on the starting point. Okay, so don't duplicate that. Oops. Instead, this is saying that, I think that in the second year, maybe way over here, I'm going to need to buy another truck. So I might have to put in a $25,000 purchase there. Okay. If you think that you're going to need to add some of those things, and some of them might be smaller than that, maybe more minor, then that's where you would put this, okay? It's just adding, oops, I should have put that down here for vehicles, not up there where I put it. Shame on me. Let's see if I can move that there for vehicles. That makes a little bit more sense, okay? So you may well think that there's going to be some equipment, machinery, vehicles, furniture, fixtures, possibly real estate. That would be pretty rare. Okay, it would be unusual for me to see a lot of projections here, but for some of you it may well fit. And so feel free, if you have some questions, you can sure ask. That should be it for the additional inputs. But let's go take a look at the cash flow. And most of this is going to get filled in for you. Okay. If you come down here again, there's only the 4 orange lines. So additional inventory, all this is saying is your inventory, this program's going to automatically calculate that you're replacing your inventory on a regular basis based on the sales. But as you're growing, if you think that you might have to add some inventory, okay, and that wouldn't be unusual depending on the type of business you are. You might decide that you're going to add, a little bit of inventory. Maybe you're going to add $100 a month worth of inventory. Maybe you got the busy season or something too. Okay, that's fine. So you may put that in there. But again, it's only if you want to increase the normal level of inventory that you have in your store. Okay, if your starting point says that you're going to buy $50,000 worth of inventory and you've got sales and whatnot, it's automatically going to calculate keeping your inventory level at that $50,000. This would only be if you wanted to work at upping that inventory to $55,000, say. Okay, you might do a few $100s a month or $500 a month for 10 months to get it up to there. So again, it would be a little bit unusual to see numbers in here. A lot of you don't have businesses with inventory. But if I see some, they're usually fairly small. Owner's distribution. This is where you pay yourself. I fully expect that you will have some owner's distribution here. Okay, it's not unusual to go a few months without it. Okay, I will tell you that when we used to send applications into the SBA and they'd look at it, if there was no provision for owner's pay, they'd kick it back and say that's unrealistic. Okay, owners need to take some money out unless you're married to a doctor or something, and that was legit. Okay, so owner's distribution, again, you might start out at 0, but you might say, oh well, okay, in month 7 I'm going to start taking out $500 a month. Okay, so I take out $500 per month. And we'll get into this. You're going to have next year too, and you may end up taking some money out in the following year as well. Okay. The only other dividends, because again, unless you're a C corporation, you're not going to pay dividends. So most of us, you're not going to have anything there. Let's not worry about that. Let's go back to line of credits. See here, I created a line of credit when I paid myself, and that's because I don't have a lot of stuff entered in here yet. Okay. I don't have any kind of a sales forecast, right? And so, let me put in a sales forecast here of something. Okay, and I'm going to sell 500 of them. I'm going to do that every month here. Let's see what happens. See if that gives me something to go by. So when I come and look at my cash flow, okay, it shows that I'm going to still be creating a line of credit balance. So let me jump back here and let me bump this up to 2,000 units. I just want to do this for demonstration purposes. And I come back here to my cash flow, okay, and I'm still not making enough money to pay that darn thing off. Yeah, because I got a little bit of cash balance there, so I got to go back and I got to project some more. You guys might have something like this could happen. So let's project $2,000 per. Okay. Now, as I'm looking at this, and I come here and I've got a line of credit that gets created here. Okay. But now all of a sudden this is evened out, and I look here and I've got an operating cash balance that starts to accumulate. Okay, so I'm getting to the positive here. I need to pay this off. I don't want to keep paying this interest that's accruing up here because I have this line of credit. And so at some point I need to pay it down or pay it off. And I may say, well, geez, I got $792 here, and oh wait, well, I can't pay it all off, but I'm going to pay off $400 of that. So I enter 400. I got a balance now of 429. I got 700. I can pay it off now this month, so I might enter $429. Gives me my zero balance there. Okay, just give you some examples. Your guys you're probably going to start with stuff down here. You may have line of credit. It's not unusual to have a line of credit balance. It's not unusual not to have a line of credit balance either. So that could work for either way. Make sure when you're doing your cash flow that you look at the next 2 years, but it's the same stuff. It's the same things that you could enter if you choose to. For sure, you're probably going to have, if you have owner's distribution in the first year, you're going to have it in years 2 and 3. So that's the one that's for sure going to carry over. Whether or not you have a line of credit going into the second or third year, don't know. If you do and you're accumulating some cash, then you may want to pay it off. If that line of credit keeps getting bigger, we may have some problems. Then either we're going to have to forecast some more sales, or we might have to work on our operating expenses, those types of things. So this is kind of a good way to check out and see if your estimates are working out like you expected in terms of sales and in terms of expenses and those types of things. I'm about out of time here, so I had better quit.